I'm pleased to welcome our first guest, Ben Brown, Managing Partner at Brookfield Asset Management Real Estate Group and Head of the Americas. Brookfield Asset Management has nearly $1 trillion in assets under management worldwide across over 30 countries, including $268 billion in real estate. Ben oversees the real estate activities in the Americas region, including investments and portfolio management. And additionally, Ben is the sector head for office globally. Ben, welcome. It's great to have you in the studio today.
Yeah, thanks for having me.
We're definitely going to cover a little bit of office later. I'm not going to lead with that, but I do want to start big picture. And actually, I want to cut to the chase and talk about what is the outlook for commercial real estate right now? Because it's been a tough couple of years, down 12% in 2023, down about 2.5% so far in 2024. So what changes for real estate going forward?
We're heading into an environment that's much more stabilizing in nature, provides a much better backdrop for go-forward returns. It has been a pretty turbulent past couple of years, and it's been primarily around the capital markets. Most fundamentals across most sectors have been pretty positive, and so we've seen growth across all of our businesses, but we've seen a lack of debt availability and an increase in costs. When you have such an acute rise in rates, real estate is impacted by the rate environment. And so we're heading into a more supportive rate environment, a more stabilizing rate environment, and that should mean that there's really good performance from real estate portfolios.
Well, this is why I wanted to have this conversation right now, because a couple of years ago, I was moderating a real estate panel and I asked the question, at what point do you see an inflection in real estate? And back then, the answer was, well, the Fed is going to start cutting rates. And here we are, the Fed cut rates once, they're probably going to go again November, December, and into next year. So how meaningful are those rate cuts to the commercial real estate market, and how quickly might we see the relief from these rate cuts?
Rate cuts are very impactful, and it's really across all segments of the real estate markets. But what I would say is it's really more impactful because it changes sentiment. It's really less important, I think, the pace and the severity of cuts as it is directionally rates going down and being in a more stabilizing construct. What I would say is as we've neared the first rate cut, and now we've had it, we've seen debt markets open back up and be much more constructive. We've seen base rates come in and we've seen spreads tighten. And so cost of debt has gotten cheaper, availability of debt has gotten more prominent, and that means transaction volume is starting to come back. And that's really the flywheel that we need of activity to continue to see real estate markets open up and recover.
Look, a lot of investors have been worried about the default risk in commercial real estate, and we've certainly seen that, especially in the office CMBS, for example. We've seen defaults rise. People worried about the wall of maturities, which is this year and next year and, frankly, the next couple of years. So can we put those fears aside at this point because of these rate cuts?
Look, I think it's nuanced. I think rates coming down helps because you have a couple different dynamics of catalysts to some of these events. One is just time, and time has been dealt with over the past couple of years with many lenders just extending these loans, which means that wall of maturity has continued to get pushed out. Time isn't solved by lowered rates. What does help and where you do get the relief is operating cash flows, because we've been in a high inflationary environment, have grown across most sectors. And if debt service starts to come down to a level where operating cash flows are covering, the ability to refinance and roll those financings forward gets a little easier. What I would say, though, is as you've seen such an acute increase in rates, financings that were done 3 years ago in a very different rate environment still require a tremendous amount of new capital to come in. And not every sponsor has new capital to invest or a basis that they're willing to invest in. And so rates coming down helps. I'd say it's most beneficial for new capital, but there's still a real overhang of incremental capital needed for capital structures to be reset to today's values. And that's happening real time, and that's the opportunity set ahead of us.
So how quickly is that cost of debt reset going to happen? And how much do they need to come down until investors can feel really comfortable with that cost of debt being below the net operating income growth?
I would say it's happening, and we're starting to see it where many transactions today are now seeing positive leverage, where I'd say over the past couple of years, that was a harder dynamic where you saw many deals transacting. It was negative leverage. But when I say many deals, it wasn't many deals. I just mean that the majority of deals happening. We saw transaction volume drop meaningfully over the past 12 months. It's picked up quarter over quarter the last 2 quarters. I believe the next quarter, you will see the same directional growth. And into 25, I think we'll see a tremendous amount more of transaction volume.
The other thing investors worried about is the lack of availability of capital to invest in commercial real estate, or, lack of capital or lack of willingness, either one. And, of course, the regional banks have retrenched quite a bit and other banks have retrenched, but it seems like you are actually seeing plenty of capital that is willing to be deployed into real estate.
So you kind of have two dynamics. You have a record amount of dry powder on the equity side, waiting to invest and access the real estate markets today. You do have a shifting landscape of the debt availability in the market. You had regional banks being pretty supportive for many markets in terms of local and smaller scale lending. And then you had the money center banks, and they've both pulled back from commercial real estate over the past couple of years. We've seen a shift to alternative sources of financing. So insurance companies have been much more focused on deploying capital into the real estate space, and generally just the growth of private credit as alternative lenders into real estate is growing and will continue to grow. And is really a huge market opportunity generally. So I'd say we're going to see the quantum of debt availability still look like it has historically. I think the shape of the participants will look slightly different.
So where are you finding the most compelling investment opportunity right now across sectors?
We invest globally, and we invest across pretty much every institutional asset class. And we have the ability in our business, and specifically with our global funds and primarily our opportunistic strategy, to shift capital where we see the best risk-adjusted returns. Right now, we've deployed about $2 billion out of our current opportunistic strategies to $15 billion strategy. About 2/3 of that deal activity will be deals in the U.S. When we can invest in the largest, most liquid real estate market in the world with good rule of law transparency, and the fact that we have a huge operating capability across every sector globally, but specifically in the U.S., a real deep operating capability, we think that gives us a competitive advantage. And if we can invest the dollars here where we're local and we have a deep operating capability, we're going to deploy those dollars there.
Right. And very briefly, sector-wise, are you more interested in offices quite dislocated, or are you still finding opportunities in logistics, multifamily, et cetera?
If you think thematically, the sectors that have good medium and long-term tailwinds in terms of supply and demand dynamics, it's easy to point to housing of all types, traditional apartments, single-family rentals, student and senior. The demographic shifts just really support that. We're still undersupplied housing generally. The growth of e-commerce and the further penetration that has, deglobalization, things happening closer onshore, that's really been driving supply chain and logistics. And so we've been investing across both of those sectors recently.
And certainly they've been good investments.
Yeah.
I think some of them have actually defied, the negativity that you've seen elsewhere in real estate. What about office?
Yeah.
Is that becoming an opportunity after, a 20-30% correction?
You have, again, structural oversupply, which we had even pre-COVID. You've had a change of behaviors, which has impacted demand in the near term, although it is our view over the long term that'll probably revert back to the mean. But we just have too much office space in the U.S. You've got 40% of the market that has virtually no vacancy. That surprises people when they hear that stat. And then you have 30% of the market that has 90% of the vacancy.
Wow.
So it's very barbelled, and we've seen that across our office business globally. The oversupply that exists, the market is speaking, and there's going to be a meaningful devaluation and impairment on that bottom third of the office market. And it will take a long time to work through, but when you think about what should be institutional, investable office space going forward, I think the universe shrinks, and I think we get back to a more normal office environment in terms of vacancy, rent growth, et cetera, as things settle back in. But it's an area where there's dislocation, and when there's dislocation, traditionally means opportunity.
What happens to the 30%? Where is that 90% vacancy? What happens to that? I mean, I understand there will be defaults, there will be write-downs, but what physically happens to that space?
There'll be a lot of financial impairment. Take New York as an example. It's always an easy thing for most real estate investors to understand. In a place like New York where land is finite, things will get to a value where they're close to land value, where they will be redeveloped into other things, or to a value where a developer or a real estate investor is incentivized to invest the additional capital to make them in that top 40%. What you will see at the same time is a divergence in the performance of the best. I don't see those tailwinds ending because when we talk about very little new construction, there's no new office construction happening globally of any scale. And the change in behaviors that we have seen across tenants have made them question what is the office. And what we've seen is they've said, we have to give our employees a differentiated experience. And if I'm going to ask you to come back to the office rather than sit at your kitchen table, I have to give you an experience that's better, that's amenitized, that's close to transportation, that creates something different. And that's why we're seeing higher rents in the best and a bigger impact to the bottom of the market.
I'm not sure people were talking about office being an experience, let's say 20 years ago, but help us sum this up. It's been a tough couple of years for commercial real estate, but what kind of return should investors expect from their real estate portfolio?
I think real estate is going to be a phenomenal asset class to find alpha in your portfolio. When you think about rates have peaked, pretty much globally. Values have bottomed again on balance across sectors. And fundamentals are still pretty strong. Supply and demand is in check. Now is the time. This is one of the best real estate investing environments we've seen in a decade.
That's phenomenal. And it certainly does seem like a lot of stars are aligned from both the Fed perspective, the price correction that we have seen, and some of this compelling fundamentals that you're still seeing in real estate. Ben Brown of Brookfield Asset Management, thank you so much for joining us today.
Thank you.